Hi there, welcome back to our next round of videos now for Unit 3. Still theory, but now we are looking more into mandatory disclosure, regulated disclosure, and we start with a very basic question, which is, I believe, surprisingly hard to answer. The question is whether we actually need regulated corporate transparency. Do we need regulation in this field? Is this actually required? Or could this also work based on voluntary disclosure incentives? So in the last unit, we've seen quite a few cases where voluntary disclosure is actually a thing. So we see that theory predicts voluntary disclosure to materialize. And we also know that in democratic capitalistic regimes, normally we would expect contractual freedom. So we would expect that first and foremost, we believe in the market forces to coordinate with each other and to come up with contracting regimes that serve their purposes. So I think it's a valid question to ask. Why is corporate reporting regulated? Because when you look around the globe, you see that in most countries, at least when it comes to public firms, there is some level of mandatory corporate reporting, financial accounting and reporting. Okay. So why is that? Again, like always, we have this motivating question and I give you the answer as an intuition right away. So there are various reasons why this regulation might actually be beneficiary for society. Information externalities are important, so spillover effects of information, contracting needs, so the use of information, regulated information in contracts, and economies of scale. Okay, so these are classic arguments, and we will turn to them in turn. But also, I think it would be fair to just argue that, well, regulation is the outcome of a political process. And in the end, it's political parties that bargain over political solutions. And if I'm a little bit cynical in that regard, I might also say, okay, it is regulated simply because the bargaining power was so that in the end, it has been regulated by most jurisdictions around the globe. But we will see that these two ways of explaining regulation, they don't contradict each other. So you can think about the motivation for these lobbyistic groups to actually lobby for regulation to be informed by these economic forces that are here outlined in the first sentence. Okay, so now let's look at these economic forces. So the first thing, which is, I think, very important to understand is this thing with information externalities. So in many of the typical simple voluntary disclosure games, we just think about one firm making a disclosure decision on behalf the information environment of that single firm. Okay, so when you think about the simple unraveling theory, then you see that each firm decides individually what is best for it. And then this leads to unraveling. Okay, so now in reality, we have many situations where there is information spillover in the sense that information about firm A might also be informative about firm B. And one obvious thing on where this actually happens is financial externalities. We know that stock returns are correlated in the cross-section in a systematic way. Yeah, so a whole literature in financial economics and in asset pricing tries to figure out the extent and the drivers of this correlation. So if you think about the factor zoo, right? So all these risk factors that have been found and been questioned. But I think it's obvious to see that there is some systematic correlation in returns. And this systematic correlation in returns basically implies that by learning something about firm A, you can learn also something about firm B. So that means that information about firm A is not only important for firm A itself, but also for firm B, C, D, E, and so on. Okay, so this is very important and a very important explanation for why there is a little bit of a mismatch between, let's say, who has the cost and who has the benefit for producing this information. Okay. So then there are, of course, also not just financial externalities, there are also real externalities. When you think about competitive environments, then obviously knowing something about your competitor can also help you as maybe a potential entrant into a new market. So for example, if you know information about production capacities, cost structures, and or demand for products, then obviously you can make more informed investment decisions as a competitor, but also maybe as a vertical supplier or as a consumer. And all this is good for the economy because it helps efficient resource allocation. So meaning that some disclosure of firm A can inform market participants in multiple markets And this is another externality of this information. Okay, so these things matter, right? And the problem with all these externalities is, as I said, they don't directly affect the information problem of firm A or the information decision process of firm A. So if I as a regulator, I want to make sure that these informations are being provided by firm A, then maybe, there is a case for regulating information. But, and I will come back to this, when you just think about this, you will instantly see that this is not that easy, because maybe it's welfare enhancing to force a firm to disclose, let's say, its capacity and cost structures in order to increase competition. But from the perspective of this firm that gives all this information to its competitors, this is clearly not that ideal, right? So this firm might actually suffer a competitive loss. So often when you think about information frictions, you automatically start to think about redistribution effects, meaning, maybe firm A has a little bit of a monopolistic rent here, is happy, the owners are happy, the stakeholders are happy, and now you take this monopolistic rent away, making the market more competitive, which is great for the economy, but at the same time, bad for firm A. So you have wealth redistribution, and maybe there are also cases where externalities might actually decrease welfare. I'm coming back to this because this is not too obvious to see, but there are these aspects and they require our attention. Okay, so think about the redistribution effect, because this is really important. Good. So information externalities are an important reason why people argue that the disclosure regulation is good. So now let's look at another argument, and this is related to contracting. So contracting, very widely defined, designing contracts to avoid moral hazard or adverse selection problems. Here, the point that I'm trying to make, I think, can most easily be understood if you just think about a very simple managerial compensation contract. So what you have is you have a manager, and the manager is being hired by a risk-neutral principle. Let's assume the manager is risk-averse, and there is some unobservable effort at play. So there is this problem that the manager has to exceed effort on behalf of the firm, and the principal per se cannot observe this effort. So ideally, in such a setting, you would carry the investor, the principal, you would let her carry all the risk. Yeah, so the reason is simple. The investor is risk neutral, so this is more efficient that the principal should carry the risk. But we know from standard agency theory that in such settings, if effort is unobservable, then first best cannot be achieved. You have agency costs, and these agency costs basically result from you motivating the manager or the agent via a risky performance measure, and then this creates this agency loss. So now a very simple and straightforward point here is, well, if you can establish a sort of a reporting regime that motivates the manager to report effort truthfully, then you can reach first best. So you could have more efficient risk sharing in the economy, and this is a very important point. Okay, so if you understand contracting as the conditional optimization of contracts based on the information environment, it becomes relatively obvious that if you can improve the information environment, you can establish more efficient contracting. And sometimes you have situations where this is relatively hard to achieve in private contracting because managers are unable to commit to a certain reporting regime. Yeah, so voluntary reporting doesn't work, but because as soon as you write contracts on this information, you change the incentive to report this information, and then cheap talk will break down simply because the incentive is such that managers will start to misreport, right? So you remember the videos of the last unit. Meaning that there's a case to be made here that if you can enforce, let's say, efficient reporting and transparent reporting regimes, then the economy might be better off in that setting, right? So because the manager is indifferent in the end, because he's always held at a competitive zero in terms of utility here, but the principle is better off, so firm value increases, welfare increases. Okay, so contracting is another argument why people argue that it might be good to regulate transparency here. So next point, economies of scale. Here, I don't give you much beef, but in principle, I think it can well be a very important point. So think about the following. Think about a setup where you say, okay, I agree that some transparency is good, but I don't want to regulate the let's say the specifics of the reporting regime. Yeah. So if you do this, then you run into a situation that maybe all these firms have different reporting regimes to offer, right? Firm A does this and firm B uses a different regime. Then, of course, it becomes hard for stakeholders, for the receivers of this information to process the information because they have to deal with all these different regimes. And this increases costs and makes everything inefficient. So if you manage to coordinate on one reporting system, then you can realize these economies of scale because now multiple people are using the same reporting regime, requiring upfront investment to learn the language, let's say, or learn the trade of the reporting regime. But then you can understand multiple firms at relatively little cost. Okay, so this is this idea of standardization, and also strongly linked to this accounting notion of comparability. So and meaning that if you have a standardized system which makes information comparable, then the information production and also dissemination and acquisition cost decreases, and this is good for the economy. So it reduces transaction costs. Okay, perfect. So if you take all this in combination, then you might say, okay, I get it. There are tons of reasons why this should be regulated and accounting reporting should be regulated, but it's not that easy. Yeah. So first thing is, we didn't talk about the direct disclosure costs. So the costs of actually producing all that information, and they do exist. And in many cases, they might not be marginal, right? So if you think about maybe these established large publicly listed firms, then maybe you'd say, okay, while the cost might run into millions, but if you have sales and revenues of billions, then maybe it's not that substantial. Okay, but when you think about a small entrepreneurial activity and you think about reporting burdens for these very small firms, then you can well imagine that on the margin, these additional, let's say, bureaucracy costs can actually trigger firms to say, okay, no, let's not do it. Let's rather stay employed or something like this, right? So on the end, so these disclosure costs matter, and it's extremely hard to offset the benefit from disclosure with the cost of disclosure here, because as we've seen in the discussion around externalities, that the benefits often materialize with subjects different from the subjects that actually have to bear the direct costs. Very tricky, very hard, right? So next thing, we talked about externalities enforcing wealth transfer, so distribution effects, and these are politically very costly. So think about, let's say, discussions around competition and competition disclosure. So whether it is good for the economy to force firms to disclose their competitive edge. Yeah. So while this might increase competition, it also leads to, let's say, wealth distribution and creates potentially adverse incentives in terms of for firms to actually innovate and to become a monopolist in the first place. So really hard to come up with a clever way on how to balance these costs and benefits, right? And then another thing, and this is something that I find very important to understand, there are contractual arrangements that actually build on asymmetry, information asymmetry. So insurance comes to mind. Insurance markets are very important for our economy. So risk sharing across the wider cross-section of individuals is something that is very beneficiary for us. So think about health insurance, for example. Now, think about a system where there would be complete transparency about future health risks on individuals, right? So this would be very Orwellian. But if you think about it now, as a mind experiment, you would see, okay, if this would be completely transparent, then the insurance market would actually break down, because there would be no point in insuring somebody if you see, oh, this is a high risk person. So to the extent that these markets become more transparent, risk sharing is actually being reduced. Yeah, and this can be really bad for the economy. So risk sharing is a good thing for the economy, and risk sharing can be improved by transparency, as seen in our bare bones contractual example, but it can also be weakened by transparency, for example, like in the insurance market at times, right? So, but also the insurance market can benefit from some level of transparency. So you see, it's complicated, right? So, but I think what I want you to take away from this is that it's not really that you can say, okay, it's a very clear-cut case here. Contracts always lead to more benefit of regulated transparency. No, there are contractual arrangements that actually need in transparency. So another thing, often we decide on the regulation of corporate reporting a little bit with the idea that if it's not regulated, then nobody will do it. But we have to think about private versus public information production, right? So private information production can be really innovative. And so if you provide mandatory reporting, then to some extent, this might crowd out private information production efforts. And this is also not necessarily a good thing. Yeah. So you see, life is hard. Trying to wrap this up. Well, there are very strong points to be made for some level of regulated transparency, but it's not obvious. Yeah. So it's not that you can say, okay, this is a clear-cut case. It's relatively clear that for some firms, maybe the benefit might outweigh the cost, but maybe not for others. So, and one interesting thing where you see this, for example, is this notion of public versus private firms. Yeah. So when you think about public firms, you see that in most jurisdictions around the globe that have organized equity markets, you will see some level of disclosure requirements for public firms. And they also have become relatively standardized over the last decades. Now, for private firms, and this is really interesting, the disclosure requirements actually differ widely from the European Union, where firms have to file and publicly disclose their financial statements, although in abridged form, to the US, where you basically cannot get any information on private firms if they don't disclose voluntarily, and they're not required to do so. And this is, really a fascinating field if you think about all this variance in the cross section, right? And you can also link this to to the understanding of the relative importance of public versus private contracting. So, is it in a jurisdiction where private contracting is relatively cheap, relatively efficient? Maybe you don't need that much public information. Yeah. So, interesting things. Another aspect here is that. So for a normal economist, you might say this is maybe a little bit unfortunate because it makes life complicated. But for us as accounting researchers, this is actually a great thing. Details matter. So all these decisions will depend on what are the information sources, what are the available disclosure channels, what are the frictions in information that we have in mind, what are the contractual arrangements that we focus on. All this, you can't come up with a simple general clear-cut answer to this. So it really depends on the question that you're looking at. And this makes it complicated, but at the same time also very interesting to study. A last aspect, because all this, the political economy of standard setting and transparency regulation is a very interesting field. Meaning that because the case is not clear-cut, it's interesting to understand who actually lobbies for and who lobbies against transparency, and what are the rationales for doing so, and how can you see, let's say, over time which jurisdictions go towards the one or the other. So you can also think about this as a little bit of a path dependency in the regulation in a Douglas North type of way. So all this is really fascinating, exciting area, and I would like to see more stuff on this being done in accounting as well. So be my guest.